Okay, we're on. So where we left off, we were at slide 11 on deck 3. And so we're now going to talk a little bit about the small business deduction in further detail. And we're going to spend a bunch of time today drilling into the various components of the small business deduction in quite a bit of detail. Because if you end up working in Edmonton or in Saskatoon, or even just for a smaller firm in a larger center like Calgary, Toronto, Vancouver, Montreal, the small business deduction is going to be very important to your clients. So it's a pretty important piece to understand, even if you're going to less so if you're going to go work for a seven sister firm. Your client base will never touch the small business deduction, but for the rest of us, it matters. So some attention is warranted. So the question that we have on slide 11, it's a policy discussion of why do we have the small business deduction at all, right? And what's the point of doing this? And so the slide suggests there's 3 rationales for the small business deduction. First, capital market inefficiency. Second, positive externalities. And third, integration. The integration point is, you don't see that mentioned anymore a lot. That the idea being that because it ties back to what we talked about last week, that because the corporation is a separate taxpayer and is taxable regardless of how taxable the shareholder is, that perhaps if you had a lower income person earning income through a corporation and you have the small business deduction rate so that they're only paying tax at, say 11% instead of 23%, that maybe they're not going to end up being materially overtaxed relative to what they would have earned had there been a flow through of the income, because the corporation was not a separate taxpayer. I don't really think that's relevant anymore. Even at 23%, you have to be fairly low income to be paying tax at an effective rate of 23% or less. And especially because on the dividend piece as well coming through, if you're paying 23%, which means you're going to be generating GRIP, which we'll talk about later when we talk about corporate distributions, what that means, and you have eligible dividends, you can get up about $60,000 tax-free, even with taxable dividends, just using the basic personal amount and the dividend tax credit, etc. So it's the integration thing I think is less of a concern. It's really the first 2 rationales that are important, I think, and do get cited a lot as reasons why the small business deduction is okay. So the first rationale, the capital market inefficiencies, the idea here is that the small business deduction may be justified because hypothetically banks may not be willing to lend to small businesses at fair, at competitive rates or on favorable terms. And so by allowing these corporations to have additional retained earnings that they can reinvest into the business, it allows them to grow, etc. Right? And the second rationale is the one that you hear from politicians, because obviously politicians are not going to talk very much about capital market inefficiencies unless you have some Redditors trying to run up the price of shares of GameStop. But otherwise, the reason that you will hear politicians justify the small business deduction, and especially justifying cuts to the small business rate, is that entrepreneurs create jobs and foster innovation. So we don't want to discourage entrepreneurs from forming businesses by having high tax. So we have both. I think we're all intelligent enough to realize that both of those rationales have pretty significant problems. The first is that there isn't much evidence that banks aren't willing to lend money to profitable businesses at on competitive terms or at favorable interest rates, especially in today's interest rate environment where the Bank of Canada rate as of right now is like 0.25%. If your business is profitable enough that the difference between 11% tax and 23% tax is a material number, a bank is going to lend to you on terms that are going to be reasonably favorable. So, in 2021, that justification doesn't seem to really cut. And moreover, the businesses that need help with capital formation are probably not going to be the profitable ones, right? It's the before they're profitable capital accumulation that becomes really important, and the small business deduction doesn't really do anything about that at all. On the second rationale, it's not really clear. Like, there's not great evidence that tax rates have much of a driver on business formation. Some of the evidence that's out there suggests that, for example, reducing regulatory burdens that accompany business formation would be more important. And as well, if you're trying to reward risk taking, et cetera, things like flow throughs of losses or expensing of capital invested in the business might be more effective than a tax rate that just that's available as effectively a benefit because you're making money without any inquiry into how that money is being made. And that last point is especially important because what you're going to see in practice is that some of the people who are the biggest into claiming the small business deduction are professionals and farmers. In which case, in both of those cases, they're going to be carrying on that business no matter what, right? And so, really, in the case of the professionals, the business, the corporate income is really a substitute for labor income, and so you're not incentivizing anything that wouldn't otherwise happen. With the farmers, again, people who are farmers probably would be farmers no matter what. They seem to all like farming. And again, so what are we actually incentivizing there becomes a question. And again, on the labor point, the idea that small business is going to generate and forward job creation, most small businesses, or at least a plurality of them, are never going to employ anyone other than the founder. And really, in Canada, like in most countries, most job creation is being done by large corporations. So it's not really clear that some of our love for small business is actually justified, and especially not translating into a large tax expenditure for small business. And the other thing that we're going to see as well, and you will experience in practice, is that the small business deduction does lead to inefficiencies where people will structure their business affairs in a way that maximizes or preserves access to the small business deduction. And they will favor investments in things that generate active business income versus not active business income in order to try to get access to the more favorable rates for small business deduction income, even if that isn't necessarily an economically efficient investment. So it creates some bad incentives. Moreover, again, like I mentioned, the fact that we give you this effectively tax reward for making money as an air quote small business doesn't mean there's any guarantee that people are going to reinvest the money in the business. If you have a very capital non-intensive business, for example, like a professional would, like a doctor or a lawyer or an engineer or something like that, in all likelihood, the money that's saved from the small business deduction is going to be plowed into investments that are not in any way tied to the business. So again, it's not really clear that if the purpose of the small business deduction is to allow capital formation by small business. It's pretty poorly targeted as a means of doing that. So, all of these points that we've mentioned are why, certainly in academic circles, you don't see a ton of love for the small business deduction. There certainly have been more calls to kill it in the media in the last 6 months than I can recall having ever seen before. And you see people who are not really bleeding heart socialists like Jack Mintz who are coming out and saying that and have always maintained that the small business deduction should be killed, and in its place we should consider having something like refundability of losses for small businesses or capital expensing for small businesses, because that would actually reward the risk-taking behavior or the capital accumulation behavior that we're purportedly trying to incentivize. Again, my view is that Mintz is not wrong about this. I mean, I have a feeling that columnist Jack Mintz would complain vigorously if the Liberals were to propose repealing the small business deduction. But academic Jack Mintz, I think, is correct that the small business deduction probably doesn't serve the purpose that it's supposed to serve. So with that, we can move to slide 12. And we can start looking at the technical aspects of the small business deduction in greater detail. We know from last week the small business deduction is in subsection 125(1). We know from last week that the effect of the small business deduction when you compound the federal legislation with the Alberta legislation is to reduce the effective corporate tax rate on business income that qualifies from 23% to 11%. But we're now going to get into how that works and why it works. So if you want to open your ACTS to subsection 125(1), let's take a look at the preamble here of subsection 125(1). And the question on the slide is, well, what are the strictures that we're placing on the small business deduction in the preamble of subsection 125(1)? And so I will kick that question to the crowd. And if anybody wants to go for it, now is your chance.
Yeah, it looks like the corporation has to be a CCPC is one of the requirements of it.
Yep, and that's exactly right. That's exactly right. So that is the main stricture that we see in the legislation with the small business deduction, is that the corporation has to be a CCPC throughout the taxation year in respect of which the small business deduction is claimed. The throughout part is kind of useless here, because I think we may have talked about this a little bit during last week's class, is that subsection 249.3.1 deems there to be a year end when a corporation shifts from being a CCPC to not a CCPC. So it's not like it's actually, I don't think it's possible to be a CCPC for less than throughout the year. So really the requirement, I think, should be read as being a CCPC at the end of the taxation year in respect of which a small business deduction is claimed. But yeah, that's it, right? That's the main stricture on accessing the small business deduction. So we talked about what it means to be a CCPC last week. So from reading that if the corporation is controlled by non-residents or by public corporations or by some combination thereof, or by a hypothetical shareholder, that's a combination of non-residents and public corporations, it cannot claim the small business deduction. So that's great. And then we can keep going, and we can start with the effects of paragraphs 125(1)(a), (b), and (c). And I will prime you a little bit for these by saying that their purpose is to limit the amount of the income of the corporations eligible for the small business deduction. But if anybody wants to take a stab at guessing what paragraphs A, B, and C do, again, I will yield the floor to you. Michael, go ahead.
So I don't understand what subsection B does, but subsection A just seems to limits the deduction to the actual, well, I guess notionally the income from the corporation's active business, and then C limits it to 500,000.
Yeah, and so that's exactly right. And so your description of C ties in with subsection 125.2 and subsection 125.1.1, which we'll talk about in a sec. But yeah, that's exactly right. So what paragraph 125.1a does is it caps the small business deduction entitlement at the corporation's income from an active business carried on in Canada in the year. And as well, if the corporation has income that is described in the definition of specified corporate income or described in the definition of specified partnership income, both of which we're going to talk about and both of which you will hate me greatly after we talk about, then it limits the amount from those sources of business income to the amount that is specified partnership income or specified corporate income. And again, we'll see what that means. It's basically an attempt to prevent multiplication of the small business deduction. So that's paragraph A. And what we see from paragraph A, again, there's another stricture here, and in fact, two strictures here that are relevant. First is that the business has to be an active business. That's, so that is a defined term in subsection 125.7, and we're going to talk about that later today, about what it means to be an active business versus not an active business. And we also talked about it a little bit last week as well. The other part is in Canada. So the business has to be carried on in Canada. If it's carried on, for example, outside of Canada as a foreign branch of the corporation, then the corporation is not entitled to the small business deduction in respect of that income. So this is sort of a targeting measure here, that if you're not carrying on a business in Canada, you're clearly not ever going to be employing somebody in Canada or forming capital that's being invested in the business in Canada. So we're not going to give you the small business deduction for that. So that's, and moreover, you'd probably be subject to tax in the foreign jurisdiction anyway, since you'd be carrying on through a permanent establishment in that jurisdiction. And so it really wouldn't matter, because most comparator countries have effective tax rates that are higher than 11%. So really, who cares? So paragraph B was the one that Michael wasn't quite sure what was going on there. And I mean, that's entirely understandable and entirely fair. I think I have associates who I don't think quite understand what paragraph 125.1b does. Basically, what it does is it caps the small business deduction entitlement of the corporation at the corporation's taxable income for the year. And in arriving at the corporation's taxable income for the year, it effectively backs out any foreign tax credits that were claimed by the corporation in respect of its taxable income, and it backs out any income that was otherwise exempt from tax when earned by the corporation. So that's the idea there. So as a shorthand, if you want to ignore the part about the foreign tax credits, etc., just think that paragraph B caps the small business deduction entitlement at the corporation's taxable income. So you can't have more small business deduction eligible income than you have taxable income, basically. And where you might have a gap between between business income earned in the year and taxable income, a couple examples. One might be if you had income from an active business, but you had losses from a source that is, from a different source, like say a source that is property in the year. And so your taxable income would net to a lower number than your business income. Or for example, if you had a loss carry forward and you had income from your active business in some amount, but you also had a loss carry forward. And as a result of deducting the loss carry forward from your taxable income, then you would have taxable income that's lower than your business income. And again, that actually does happen that way, because that's how the structure of the act works, is that your computation of income for your business under Section 9, Division B of Part 1 is different than the deductions from taxable income, which is where you take your loss carry forward deduction. So that can happen. And then Michael was entirely right on paragraph 125(1)(c). It caps the small business deduction at the corporation's business limit for the year. And that ties into that ties into the next bullet on the slide, which is asking about the corporation's business limit. And that's where subsection 125(2) comes in. And what subsection 125(2) does is it specifies that the corporation's business limit is $500,000, unless the corporation is associated with other corporations, in which case you may have a somewhat different result. So next, we can move on to slide 13 of Deck 3. And we're now talking about rates. And this is largely a refresher of what we talked about last week. But if somebody wants to walk through how we get to our small business deduction eligible income, I am all ears. All right. Well, having reached my tolerance for awkward silence, let's just do this. So, again, as a recap, right? We start with our corporate rate in subsection 123(1), which is the 38% default federal rate, right? And then we go to subsection 124(1), which allows us to take a provincial abatement of 10% if the income is earned in a province. So, I mean, since we're talking about the small business deduction rate, first of all, we know from the last slide that the income has to be earned from active business carried on in Canada. Therefore, it kind of follows that the income is going to be earned in a province. But in any event, and just cutting off what may be a smart-ass question out there, for the purposes of the Act, a province is defined as including the territories. So if it's earned in the territories, it's also earned in a province. And as well, I think, I stipulated in week 1 and last week that in this course, we're going to assume all income is earned in a province. So that's a 10% rate reduction. So that takes us to a federal rate of 28%. Then we know that this is going to be eligible for the small business deduction. So we can flip to subsections 125(1) and 1.1. And we know that then there's going to be a rate reduction in subsection 125(1.1) of 19%, which takes us down to a federal rate of 9%. And then we turn to subsection 21 2.1297 of the Alberta Corporate Tax Act, which provides for basically a reduction of the Alberta rate of 8% by 6%. So it provides for a 2% Alberta rate. And that gets us to an 11% corporate tax rate for small business deduction eligible income in Alberta in 2021. All right. So then That's well and good. And so can I quickly recap that, please? Yes, you better believe I can do that. Again, the starting point is subsection 123.1, which is the 38% rate. Then, because we're assuming all income is earned in a province, you go to 124 sub 1, take your 10% provincial abatement, which gets you to 28%. From there, you go to subsection 125.1 and 125.1.1, which provide for a 19% further rate reduction, which takes you from 28% to 9% federally. And then you go to subsection 21, 2.1297 of the Alberta Corporate Tax Act, which provides that you have a provincial rate of 2%, and that gets you to an all-in small business deduction eligible rate of 11% in Alberta. So that's the quick recap. And then no problem. And so then we go to our next question, which is asking about income above that threshold. And this is because the small business deduction is capped at the business limit in subsection 125.2, which is $500,000. You will have many corporations that are earn small business deduction eligible income, but in excess of the $500,000 threshold. And so that income in excess of the $500,000 threshold gets taxed at the general rate. And that's what this question is asking us, is how do we get to that general rate? And so then the answer there is that we're going to go to, first of all, we're going to start again with subsection 123.1 and our 38% rate. From there, we're assuming the income is earned in the province, because obviously the income under $500,000 was small business deduction eligible. So this also must be as well. So we have our 10% provincial abatement under subsection 124.1, and therefore a 28% federal rate. Then we go to subsection 123.42, which is the general rate reduction. And so we have a 13% general rate reduction for this business income in excess of the small business deduction amount, which takes our federal rate from 28% to 15%. And then we go to paragraph 21X of the Alberta Corporate Tax Act, which provides for the Alberta provincial rate of 8%. And that gets us to an all-in combined Alberta-Canada rate of 23%. So again, very similar process to how you get to the small business deduction rate, but instead of worrying about subsections 125, 1.1, and 1, you're instead worrying about subsection 123.42, and you're looking at a different provision of the Alberta Corporate Tax Act. Yeah, so can I do that again? Absolutely. So again, starting point is subsection 123.1, which is the federal rate of 38%. Then subsection 124.1, which provides for the 10% provincial abatement, which takes you to a net federal rate of 28%. Then you go to subsection 123.4 sub 2, which provides for the general rate reduction, which is 13% rather, which gets you to a federal rate of 15%. And then you have to add in the provincial tax, which is paragraph 21X of the Alberta Corporate Tax Act, and that provides for an 8% provincial rate. And the result of the 8% provincial rate is that your all-in rate is 23%. Okay, we are good there. You're welcome. And so we can then move on to slide 14. So slide 14 is talking about associated corporations, which I touched on briefly 5 or so minutes ago. We don't know what association is yet. That's in Deck 4, which we're going to either start later today or next week. So don't worry about whether or not people are associated yet. Just here's where we're going to learn what happens when they are. one of the things that happens if there's other provisions of the Act that worry about association as well. But this is what happens with the small business deduction. So the effect of subsection 125(3) is that it's going to reduce the business limit where the corporation is part of an associated group of corporations. And so instead of every corporation in the associated group getting its own small business deduction, the associated corporation, the entire associated group is going to share a single $500,000 small business deduction. And what will happen is that in the T2 returns for the particular corporation, all of the associated corporations, they have to allocate that small business deduction between themselves. And basically what they do, the way they do this is you assign a percentage of the small business deduction to each member of the group. And so that percentage multiplied by the associated group's business limit, which generally is $500,000, but as we'll see, there's ways that can be ground. That's going to be the small business deduction to which the particular corporation is entitled. So it's percentage allocated in the T2 return multiplied by $500,000 or the lesser amount that is in fact the business limit of the associated group. So it's important that when the allocation percentages total to less than 100% or more than 100%, everyone's business limit in the associated group is deemed to be nil. And as well, obviously, if you allocate 0% of the business limit to a corporation, then its business limit is obviously also nil. This more than 100% allocation problem, that's not a thing that happens in real life. To the best of my knowledge, that has never happened in real life because everybody just does, T2 returns have to be filed electronically. So they're all done using return preparation software, and return preparation software is not going to allow you to allocate more than 100%. I mean, maybe there's somebody here who's prepared T2 returns before who, thinks we can somehow override that field on the T2. Number one, you're not going to override it. But number two, it's not going to do it. So you don't have to worry about that in real life where you could over allocate small business deduction that everybody deemed to be nil. Subsection 125(4) is the next part of this. And what subsection 125(4) does is it provides that where an associated group has failed to allocate the small business deduction between its members, the CRA can make the allocation for the associated group. So, and there's no strictures on that. The CRA can allocate the small business deduction between the members of the associated group in whatever manner the CRA decides is appropriate. So you're never going to do this on purpose, right? Because, the client's idea of where the small business deduction should be allocated is always going to be better than the CRA's idea of where the small business deduction should be allocated. Where you would see this happen with the CRA making the allocation would be in circumstances where people were taking the position that two corporations were not associated during a taxation year. Both corporations claimed the small business deduction, and then the CRA came and reassessed on the basis that they were in fact associated on some basis. And again, we'll talk about that in Deck 4, what those bases might be. But in that case, then CRA probably is going to make the allocation of the small business limit between the members of the associated group. So that's a place where subsection 125(4) could apply, because by virtue of everyone taking the position that they were not associated, nobody made the allocation required under subsection 125(3). So the question that arises here, which I could throw out to everyone, but again, I think is sufficiently obvious, is the reason that we have these rules in subsection 125(3) and 4, is to prevent the multiplication of the small business deduction, right? Like back in the day, in the 1950s, when we first did the small business deduction, if you wanted more than $500,000 or whatever the number was back then, it was probably like $50,000. If you want more than that, you just incorporate another corporation. right? That was it. Tax planning was ludicrously easy back then. Obviously we're trying to prevent that, right? By making it so, by making groups that have aligned economic interests share the small business deduction. First of all, it's in keeping with the idea that the business limit should be $500,000. But also it means that people who are, associated groups that are too big are not going to get the small business deduction. We'll see how that happens as well. But that's the idea, is just to have everybody who's economically the same share a single $500,000 business limit. Okay, so we can now go to slide 15. And this is where stuff does start to get a little bit painful with the small business deduction. Is, first of all, the specified partnership income concept. So in handout 9, there is some discussion of specified partnership income. And the idea here with this concept of specified partnership income is that the $500,000 cap in subsection 125.2 could be easily circumvented by non-associated persons if they used partnerships. So for example, if we had two shareholders who both invested in shares of a corporation that earned $1 million of business income, only the first $500,000 of that business income would qualify for the small business deduction rate, and the rest would be taxed at 23%. However, absent the specified partnership income concept, you could have a situation where one partner could form a corporation, the other partner could incorporate a corporation, the two corporations become partners of a partnership. And the partnership earns $1 million of business income, allocates $500,000 to each member, and then each member has a $500,000 business limit. And so the entire $1 million of business income is now being taxed at the small business rate. So, that's a result that would otherwise not have been possible, but for the use of the partnership. And that's what the specified partnership income concept is intended to prevent, right? The idea here is that if there is one business, then there is one business limit, and it doesn't really matter how the business is structured. That's all you're supposed to get. So this is a very real concern, especially with professionals. As I said, I think a lot of the small business deduction claims are being made by professionals, and it was a big deal, right? Because absent the small business, absent the specified partnership income concept, every partner of Stykes or Blake's or PwC might be entitled to claim a small business deduction of their own. And that's kind of an absurd result, because there's only a single business being carried on by Stykes or Blake's or PwC, and their income from that business is vastly in excess of $500,000. So, we need an anti-avoidance mechanism to prevent that kind of small business deduction multiplication chicanery if our policy determination is that one business should get one business limit only. So the anti-avoidance mechanism by which we prevent that is the specified partnership income concept. And that the first place you're going to see that is in paragraph 125(1)(a), which we looked at 30 minutes or so ago. Mechanically, the specified partnership income concept treats income from a partnership as a different type of qualifying income versus business income earned directly by the corporation. And so the amount of the partner's specified partnership income is basically their proportionate share of the partnership's income multiplied by a single $500,000 small business deduction. So if we can flip to slide 16, this is something that will make more sense when we get to an example, which we will in a moment. And there's also the concept of a specified partnership loss, which we can leave to the side for the moment, but it's basically the inverse of specified partnership income. And so specified partnership income is defined in subsection 125.7 as being the amount determined by the formula A plus B. So variable A is itself equal to the lesser of two amounts. The first is the corporation's income allocation from the partnership, with certain adjustments relating to section 34.2 and subtracting any expenses relating to the ownership or maintenance of the partnership interest. So for example, if you have an interest deduction in relation to the partnership interest because you borrowed money to acquire the partnership interest, then that would be a reduction in the specified partnership income paragraph A of variable A. Again, we talked about section 34.2 in week 1, and we kind of said we're just going to ignore it from now on. And so we're going to continue to ignore it for these purposes. So you can ignore that when you're looking at the specified partnership income definition. The second of these two amounts, the lesser of which is variable A, is a proration of the partnership's income. And so the way this works is to take the partner's income allocation, divide it by the total partnership income, and then multiply the quotient by $500,000. And so if the taxation year of the partner is less than 365 days, then you have to prorate again. But let's assume in this course that everybody has a full 365-day taxation year. So we don't have to worry about a proration for a stub year. So for most partners, this is where you would stop, right? So the lesser of the two amounts is in almost all instances going to be the second amount in variable A, which is the prorated $500,000 multiplied by allocated income over total partnership income. That's going to be usually where everybody gets capped with specified partnership income. However, variable B is still a thing, and what variable B does is it allows the partner to claim a greater share of specified partnership income where the taxpayer has business losses in the year, since the business losses would otherwise just shelter high tax income in any event. So variable B is equal to the lesser of two amounts. The first is the sum of the corporation's business losses and specified partnership losses for the taxation year. And the second is the excess of the corporation's net income over its prorated share of $500,000. So the second amount in variable A. And so the result is that even with the variable B addition, you're never going to have more specified partnership income than you have income from, than you have net income at all. So anybody have any questions on that so far? Okay, seeing none, now is probably a good time for a break. So let's take 10 and we'll come back at 2 o'clock. Okay, so we can pick back up after that well-earned break. So those of you who may have flipped over to the specified partnership income definition in subsection 125.7 and have looked at that, you're going to see that it actually looks rather more complicated than I just described and more than the handouts described, which is remarkable in and of itself. But the reason for this is a series of legislative amendments that were made in 2016. And what those amendments are intended to do is to prevent the multiplication of the small business deduction using indirect income earned from partnerships. And so let me try to explain this. This is where if we were doing this in person, I would use a whiteboard and just draw what I'm talking about. But what I'm going to attempt to describe is a couple different ways that people were multiplying the small business deduction, that this changed the definition of specified partnership income was intended to fix. And so the first would be like, suppose you had a person who was not like, let's suppose you had a person who was a member of the partnership and they incorporated a second corporation that was not a member of the partnership. And that second corporation charged a fee to the partnership. And, as a result of earning that fee, had business income from an active business carried on in Canada. And that, because it was not a member of the partnership, it, under the original specified partnership income rule, was not specified partnership income, and there was no reduction to the business limit. So this was a pretty popular option, for example, for doctors, where you could do this and you would have, every doctor would just have a second professional corporation that would invoice their professional partnership for their fees. And as a result, every doctor got a small business deduction, and the partnership effectively had had zero income at the end of the day. So the fact that the first professional corporation that was a member of the partnership would have been constrained by the specified partnership income limitation was basically meaningless. So that was option one. Option two, and obviously within those two, the two corporations are controlled by the doctor, as we'll see in Deck 4, would have been associated, but they would have just allocated 100% of the business limit to the corporation that was not a member of the partnership. So it worked out, right? Second way that people were doing this, that second common, or let's do three. There's three common ways. The second common way was what people who were not in professional partnerships and therefore didn't have to have professional corporations and comply with the professional corporation shareholding rules were doing. And this was, they would have, you'd have the partnership, and all the members of the partnership would be corporations. And the sole shareholder of every partner corporation was another corporation, which we'll call that the second tier corporation. And so the partner corporation would pay a fee to the second tier corporation. And again, because a second tier corporation was not a member of the partnership, it wasn't constrained by specified partnership income. So the partner corporation did have income that was specified partnership income, and therefore was not eligible for the small business deduction except to its proportionate share of the single partnership business limit. But what happened was that it would get a deduction for the amount of the fee paid to the top tier corporation, which was obviously going to be 100% of its income, or something so substantially close to 100% of its income that it was functionally indistinguishable. And then the top tier corporation, because it was not a member of the partnership, didn't have to worry about specified partnership income, and therefore it just got the full small business deduction on that income. Obviously, again, the top tier corporation and the lower tier corporation were associated. They had to share their business limit, but they would allocate 100% or thereabouts of the business limit to the upper tier corporation. So again, that worked as a multiplication tool. And then option three was, what people in professional partnerships did including basically every tax lawyer, every accountant, every doctor as well did stuff like this, like option 3. And what option 3 is you would have, again, a corporation that's a member of the partnerships. Everybody's had one professional corporation that was a member of a partnership. And then they would have a second professional corporation controlled by the same person. And the second professional corporation would invoice the first professional corporation for services that were rendered by the professional who was only an employee of the second corporation, not the first corporation. And so again, you'd have specified partnership income into the first corporation, but it would have an offsetting deduction for all of its income. And then the second corporation was not a member of the partnership, and therefore it had a full small business deduction available because the associated group of the two corporations allocated 100% of the business limit to sister PC rather than to partner PC. And so all of that was happening. And, again, the result was that because of structures like that, everybody, theoretically, the Big Four, I think, theoretically prevented their partners from doing that under the partnership agreement, but I think everybody did it anyway in breach of the partnership agreement. So, all the people at the Big Four, everybody at the big law firms, even everybody at the medium and small law firms, was generating a full small business deduction in respect of what was indirectly partnership income. And, that proved to be unacceptable to finance. And so what finance did was they substantially overhauled the specified partnership income concept. And so, first of all, there was a change in paragraph 125(1)(a), where instead of saying if it's a member of a partnership, kind of nil income from the partnership plus its specified partnership income, what it now says is, any income that's described in the definition of specified partnership income is out, and then you add back in the specified partnership income. What we see in the specified partnership income definition is there's this new concept of a specified partnership business limit, which is referenced in paragraph B of the specified partnership income concept. And that, again, is just our proration that we talked about before the break. And what the rules have done is that the specified partnership income definition now also captures income that's earned not only from the partnership as a member of the partnership, but also that's earned directly or indirectly from the partnership in circumstances where the corporation that's receiving the income either has an interest in the partnership or does not deal at arm's length with somebody who has an interest in the partnership. How are these three methods not prevented by GAR? Let's just say they weren't. We did some pretty thorough analysis on all of this at the time, because we were doing this for ourselves and we were doing it for all of our clients. So we satisfied ourselves the GAR didn't apply. And I think finance came to the same conclusion, which is why they legislated. I don't think they ever even, aside from maybe the odd proposal letter at the audit stage, even proposed that the GAR could apply to prevent this. And the rationale is that the GAR is not as broad as you may think it is. You do have this. You do have the have to show that there is a that there isn't a misuse or abuse of a specific provision or scheme of the act that's grounded in the wording of the provisions. And there just wasn't something that was that obvious here. And moreover, it's hard to run a GAR case on this because the tax benefit is relatively small. So you may never get a case to tax court, depending on who you decide to pick a fight with, because they'll just surrender instead of incurring the legal fees. So you'll never actually get a decision that says the GAR applies. But yeah, the moral of the story was we did, and I can't tell you exactly how we did it because it's been 5 years since we were able to think about, since we had to think about this. But we did satisfy ourselves the GAR wouldn't apply, and pretty clearly, since CRA never seriously pursued it, I think finance and CRA both came to the conclusion that they couldn't win a GAR case if they tried to run one. So the GAR didn't apply, and no problem. So what ended up happening was that like I said, they had tried to legislate this away. And so there's the specified partnership business limit concept, which is basically this this idea of the proration that we talked about is now in a separate definition. And you have all these rules as well that now apply where somebody is indirectly earning income from a partnership. In that case, their paragraph A of variable A amount is basically nil. And their paragraph B amount is also nil unless the partnership assigns some of its specified partnership business limit of $500,000 to that person who's earning income indirectly from the partnership. And so that's, that's convoluted, but basically the idea is that the definition has gotten materially more complicated, and it is in fact now two separate definitions because specified partnership business limit is carved out. I didn't really want to walk through that in any provision by provision detail because I'm just not sure how to even do that short of just sitting there and watching you while I make you read it to yourselves. It's not very conducive to lecturing it through. So, you could, but it would, if you were experienced tax professionals, I probably could have lectured that one through, but you're not. And so the working intimacy with the provisions just isn't there to make that sensible. So I didn't want to get into that in as much detail. So just know that it's there, and it's not as easy as it looks based on what I've said, what the slides say, and what the handouts say. It's actually rather worse than all that. And again, there's whole separate provisions that just deal with the allocation of the specified partnership business limit and how you go about doing that. So just be aware that that's there, and that's how it works in real life. Obviously, what has happened since then is many of these rules. It had the deterrent effect that finance was going for, because I think most people have now collapsed their two corporation, two PC, whatever structures by just amalgamating the entities together. So it's mostly back to where it should be, and the rules are sufficiently tight that there's not a lot of multiplication happening right now. People seem to have, by and large, given up on getting a full small business deduction if you're a member of, for example, a professional partnership. There's, in the farm world and stuff, people went to in real estate worlds, people went to joint ventures instead of partnerships in order to circumvent these restrictions. But like we talked about earlier, joint ventures are kind of clunky structures. And so there's not a lot of that, except where it's a family farm arrangement, and they can reasonably be assured that if they do it as a joint venture, it's not going to blow up on them in too pronounced a way. So that's specified partnership income at a high level, and and the current state of play. We can then flip to slide 17. And slide 17, we have some anti-avoidance rules that backstop the specified partnership income concept, because, what would income tax be if it's not anti-avoidance rules that have their own backstopping anti-avoidance rules? So we can work through these relatively quickly. So subsection 125.6, what this is intended to do is it prevents the creation of additional specified partnership income by causing the business to be carried out by multiple partnerships. So if members of associated groups are members of multiple partnerships, and it can reasonably be concluded that one of the main reasons to increase the amount is to increase the amount of the available small business deductions, and one of the main reasons for people being a member of multiple partnerships as part of an associated group is to increase the small business deduction, then subsection 125.6 applies. If subsection 125.6 applies, then what you need to do is need to identify the relevant partnership that has the greatest specified partnership income of the partnerships of which any member of the associated group is a member. And then the corporation's specified partnership income will be its specified partnership income from that particular partnership only. And the other corporations in the associated group will have nil specified partnership income from any other partnership. So that's basically how the rules work. And so to think about how 125 sub 6 works in practice, suppose you had a plumbing business, let's say, and the little bit I know about plumbing is that there are two main lines of business that plumbers are in. One is the servicing of plumbing, and the second is the sale of plumbing related stuff. So let's suppose that your local Mr. Rooter franchise decided that instead of being in a corporation, they were going to be in a partnership. And instead of being in a single partnership, because they had multiple members, they were going to form two partnerships. One was going to carry on the service business. And so, corporation 1 and 2 would be members of the service partnership. And then they would also be a sales partnership, and corporations 1A and 2A would be members of the sales partnership. And so that basically would be the result, because in that case, you would have two separate partnerships, both of which would have a separate $500,000 specified partnership business limit. And so as a result, each partnership would get to allocate $500,000 of specified partnership business limit to the two partners. And the result would be that instead of each partner, assuming both partnerships made $500,000 a year, instead of getting $250,000 of small business deduction, if this was just a regular partnership, each corporation 1 and corporation 1A both get $250,000, and so the associated group of 1A gets $500,000. So that was seen as abusive to split businesses up like that. And so that's what subsection 125(6) does. And again, an important point there is that it's a one of the main reasons test. So it's not the main reason, it's one of the main reasons. And obviously that, for those of you who've not seen a one of the main reasons test in tax yet, I think everyone is aware that really abuses English word meaning. And I'm sure in French, it's no less tortured. But the idea being that you can have more than one main reason, and the reasons don't all need to be equally important, but they can all still be main reasons as opposed to reasons that are not main. And so basically if basically the reduction of tax is a sufficiently important motivator for the arrangement, then even if it's not the most important motivator, the arrangement gets caught. But there are limits, right? If there's an overwhelming commercial reason to do this separately, then that would be fine. So for example, to use a real life example, suppose you have a chain of grocery stores and you're doing it in an incorporated partnership, or all the members of the partnership are corporations, but each location, there's slightly different ownership. And so, and obviously different commercial risks associated with each location, different landlords, different business profile. Like I said, slightly different interests in the partnership. In some cases, owned by slightly different people, different geographic locations. In that case, you would make a pretty strong argument that subsection 129(6) just doesn't apply, because if this was a corporate structure, all of these would be separate corporations. You would not carry on the business through the same corporation. Maybe you would if you're, like Loblaw or something. Even then, they probably have separate corporations that just get consolidated up for accounting purposes anyway. So, yeah, that's an example where it wouldn't apply. But that's the idea, is to prevent multiplication through the unnatural splitting of partnership businesses. Our next anti-avoidance rule is subsection 125(6.1, and that clarifies how we deal with stacked partnerships And by stacked partnerships, I mean a partnership where one partnership is a member of another partnership. So the top tier partner is indirectly a member of the lower tier partnership. And what subsection 125.6.1 does is effectively recognizes that reality that the top tier partner is indirectly a member of the lower tier partnership by deeming a partner of the top tier partnership to be a member of the lower tier partnership. And so the partner's income from the lower tier partnership is its share of the partnership income from the lower tier partnership that has been allocated to it by the upper tier partnership. So in this exercise, you have to figure out what the income of the lower tier partnership is, allocate that to the upper tier partnership. There may be more than one, and then the upper tier partnership, allocate that to all the members, and then you apply 125.6.1 by saying, okay, well, you partner in the top tier partnership, you were deemed to have earned, you were effectively indirectly allocated X dollars of income from lower tier partnership. You're deemed to be a member of lower tier partnership, and your specified partnership income from lower tier partnership is deemed to be that indirect allocated amount. And then we'll test on that basis whether, how much specified partnership income you really have. So that's how 125.6.1 works. Subsection 125.6.2 is intended to prevent corporations from earning specified partnership income if the business is controlled by non-residents or public corporations. So the rationale here is that the partnership is effectively just replacing a corporation that would not be a CCPC if the business had been incorporated. So the Canadian partner should not be entitled indirectly to a small business deduction had they, because they would not have been entitled to a small business deduction had they just invested in a corporation rather than in a partnership. So under subsection 125.6.2, if the partnership is controlled de facto by non-residents, public corporations, etc., then the partner's specified partnership income from the partnership is deemed to be nil. So that's a relatively straightforward rule as these things go. And then finally, our final anti-avoidance rule is subsection 125.6.3, and this is a supporting rule for subsection 125.6.2 because there really isn't a de jure control concept for partnerships. And so what it does is it provides it for the purposes of subsection 125.6.2. A partnership is controlled by persons or a person if that person or group of persons' share of the income from the partnership from any source exceeds 1/2 of the partnership's income from that particular source. So basically, it's an income allocation test. If a person or group of persons gets more than 1/2 of the income of the partnership from any source, they're treated as controlling the partnership, and therefore that ties into 125.6.2 because if that person or group of persons is a non-resident public corporation or a group of non-residents and or public corporations, then specified partnership income is nil and nobody gets a small business deduction. Okay, so anybody have any questions about that? Okay, so moving on, we can go to slide 18. And this is problem number 5. Okay, 125.6 again. Yeah, absolutely, I can do 125.6 again. So 125.6 is our anti-fragmentation rule. And so basically the way 125.6 works is that if there is, if members of an associated group are members of more than one partnership, and it can reasonably be concluded that one of the main reasons for members of the associated group being members of different partnerships is to, is to circumvent the restriction on specified partnership income, then 125 sub 6 applies. If subsection 125(6) applies, then the result is that you basically have to look at every corporation in the associated group that has specified partnership income. And you would then say, okay, well, of those members of the associated group with specified partnership income, who had the most? And then whoever has the most, that remains specified partnership income. And everybody else's specified partnership income is deemed to be nil. Basically, so your associated group gets one kick at specified partnership income if the anti-avoidance rule applies, and it's the highest one, and everything else is just flushed out. So then we have a question about 125(6.1, just to clarify, the individual who is effectively a member of both the higher and lower tier partnership, their specified partnership is deemed to be that allocated to the lower tier partnership. Is that right? So, okay. So to clarify that, so suppose we have a partnership. We're going to call this the lower tier partnership. And the members of, to make this really easy, the members of lower tier partnership, we'll call it a limited partnership. The members of lower tier limited partnership are upper tier partnership as to a 99% interest, and a general partner corporation as to a 1% interest. In upper tier partnership, let's call it Lisa. Lisa is a 25% member of upper tier partnership. And so what subsection 125(6.1 says is, and what this is actually Lisa's a bad example. It'll be Lisa Co. Lisa is a sole shareholder of Lisa Co. Lisa Co. Is a 25% partner of upper tier partnership. And so what subsection 125(6.1 basically says is to figure out what Lisa Co.'s specified partnership income is. First of all, you've got to figure out your income allocation. So let's say lower tier partnership earns $1,000 of income. Lower tier partnership allocates $999 of that to upper tier partnership and 1% to general partner. And then upper tier partnership allocates 25% to Lisa Co. Of that $999, which for all intents and purposes is $250. So then you'd say subsection 125(6.1 says, okay, in order to determine Lisa Co.'s specified partnership income, Lisa Co. is deemed to be a member of lower tier partnership, and Lisa Co.'s specified partnership income is calculated based on that 25% of 99% that got flowed up to the structure. So that's a really simple example, which doesn't actually illustrate it all that well, because to really see what subsection 125(6.1 is driving at, you would need to have you'd have to have more members of the lower tier partnership with different percentages in order to kind of see how that works. But that's the idea, is to basically test, is to prevent people from getting a greater specified partnership income allocation through the use of tiered partnerships than they would directly. So in our example, let's suppose to see what they're getting at, now that we've seen what it looks like with a 1% partner and a 99% partner, suppose that upper tier partnership actually owned a 10% partnership interest in lower tier partnership. Now, instead of $1,000, let's say lower tier partnership earned $100 million of income. So now what has happened is that we have $100 million of income in lower tier partnership. Lower tier partnership allocates $10 million of that effectively to upper tier partnership, which is a 10% partner. And then upper tier partnership allocates 25% of that amount, so $2.5 million to Lisa Co. And you say, well, okay, Lisa Co., in computing your small business deduction, if we didn't have subsection 125.6.1, we said, well, you're a 25% member of the partnership from which you earned business income. Therefore, you should get $125,000 of specified partnership income, and the remaining 2.375 million of partnership income gets taxed at the general rate. But what subsection 125.6.1 does is it says, no, actually, Lisa Co. is a deemed member of the lower tier partnership, and her income allocation from the lower tier partnership is going to be the amount that was indirectly allocated to her through upper tier partnership, which is $2.5 million. But now to compute how much specified partnership income she actually has, you're going to take $2.5 million, and you're going to divide that by the $100 million of income in lower tier partnership. And so now instead of getting 25% of a $500,000 specified partner business limit, Lisa Co. gets 2.5%. So her entitlement to the small business deduction drops from $125,000 to like $12,500. So that's the idea with subsection 125.6.1. Somewhat confusing, but that's the goal. Okay, hopefully that does make more sense. All right, so if those are all the questions, then we can go to slide 18. And on slide 18, and this is handout 5, we have a numerical example. So we can sort of see in a very simplified way how the specified partnership income example, how the specified partnership income concept actually is supposed to work. So if we flip to our handout, this is part 5, handout 9. So our corporation is XCO, which is a CCPC, and it has a 1/4 partnership interest in XYZ partnership. And this is about the part of the course where I get to reminding myself every year that I really need to give these things actual names, and I just never do it. So XCO is a 1/4 partner in XYZ partnership. For its 2021 taxation year, which is the calendar year because we really don't want to deal with 34.2, the partnership earns $1 million of business income from an active business carried on in Canada. What amount of the business income from the partnership may X add to its small business deduction base for its 2021 taxation year, which again is a calendar fiscal period? So that's part 1 of our question. And so let's try to work our way through that if we can. So if we take a look at our simplified specified partnership income definition, we know that our specified partnership income is going to be equal to the amount determined by the formula A plus B. We know that, again, in a very simplified way, variable A, paragraph A, is going to be equal to $250,000, which was the corporation's income from the partnership otherwise determined. So, so far so good. And then we know that variable A, paragraph B, in our simplified version, is going to be equal to $125,000. Which is $250,000 divided by $1 million multiplied by $500,000. So since variable A is equal to the lesser of two amounts, then we know that variable A is going to be $125,000. Variable B is equal to the lesser of the corporation's loss, which is $0, and the excess of the partnership income of $125,000. So the lesser of those two amounts is obviously 0. And so variable B is 0. And so as a result, the specified partnership income is going to be $125,000. And that's the amount that gets added to the small business deduction base in paragraph 125(1)(a). Everybody cool with that? Can I go over variable A again? I absolutely can. So again, variable A, we know it's the lesser of two amounts. And so in our simplified world, we only really care about paragraphs A and B. So we're just going to pretend that the other ones don't exist. And so variable A, paragraph A, when you drop off all the stuff we don't care about, like section 34.2 adjustments and the stuff that I'm practically not, well, just at the moment, not asking about, like carrying costs of partnership interest, etc. Variable A is just the income from the partnership. So basically, how much income otherwise determined did the partnership allocate to our particular corporate partner? And so the answer here is $250,000, right? Because that's the actual allocation, 25% of $1 million of partnership income. Variable A, paragraph B, which is the other of the two amounts that we care about, is a formulaic amount. And basically, the way you compute this is you divide the partner's income allocation from the partnership by the income of the partnership, and you multiply the quotient of that by $500,000. And again, there's a further proration for a short taxation, but we're ignoring that. So it's just the quotient multiplied by $500,000. So in this case, our formula, the income allocated by the partnership to the partner is $250,000. The partnership's income is $1 million. So it's 25 over $1 million. So basically 1/4 multiplied by $500,000, which gives us $125,000. So that's our paragraph B amount. And so since variable A is the lesser of those two amounts, it's $125,000, which is the paragraph B amount, and that is variable A. And so in our example, variable B computes to 0. And so as a result, the specified partnership income is $125,000. Not a problem. Okay, so that's the base problem. So then the problem goes on to ask, what if Exco had also, in addition to making $250,000 from a partnership, lost $50,000 from an active business carried on in Canada that was not the partnership business? So it just carried on a separate business and it sucked at it, basically. What are the results here? And so the difference here is that we now have a variable B amount, right? Our variable A calculation is still exactly the same, but now the variable B amount is the lesser of the loss otherwise determined, which is $50,000, and the excess specified partnership income that was not, sorry, the excess partnership allocation that was not specified partnership income under variable A, which is $125,000. So the lesser of those two amounts is $50,000. And so that's the variable B amount. And so now when we add our $125,000 variable A amount to our $50,000 variable B amount, we end up with $175,000 of specified partnership income. And so now we're adding $175,000 to our small business deduction base in paragraph 125(1)(a). I'm going to take silence as an indication that everybody is okay with that. All right, so then we have a further modification to the problem. And in this further modification, it says, what if instead of a $50,000 loss, there was a $300,000 loss from the other source? So now instead of sucking at it, they're just profoundly bad at this other business. What happens? So the answer here is that we have a different variable B amount. It's still the difference between a $50,000 loss and a $300,000 loss still just goes directly to the variable B amount. So what we should know intuitively is it's going to get bigger because the loss got bigger. And so that's the right answer, right? Variable A remains the same because this loss is from a source other than the partnership, so it doesn't impact the partnership's income allocation or net income. So now we have variable B. Again, it's the lesser of the loss from other sources, which is the $300,000, or the excess partnership income that was not included in variable A, which is $125,000. So the lesser of those two amounts is obviously the $125,000. And so that's our variable B amount. And so now we are going to add that variable B amount of $125,000 to our $125,000 variable A amount. And so we have specified partnership income of $250,000. And so the result is that because of this loss from another source, all of the income that was allocated to our partner corporation, XCO, by the partnership is specified partnership income and will get added to the small business deduction base in paragraph 125(1)(a). Is everybody okay there? Yeah, okay, variable B we're being asked to explain. Okay, so yeah, basically what we're doing with variable B, paragraph B, is we're adding, it's the second of our two amounts, so it's the excess income from the partnership that was not included in specified partnership income. So any amount that was effectively any amount that was in part one of, or sorry, we'll call it paragraph A of variable A. So the income allocation from the partnership, any amount that, by which paragraph A exceeds paragraph B, which is the formulaic, allocation over total partnership income multiplied by $500,000. Anything that in paragraph A that exceeds paragraph B is an amount that would be in variable B, paragraph B. So that's the excess amount. And then so the way variable B works is it's the lesser of the loss otherwise determined, or that excess amount in paragraph B. So that's why in our example, paragraph B is always $125,000, because in our very simple example where there's a 25% partner, and there's $1 million of partnership income, the amount in excess of in excess of the formulaic amount is going to be $125,000. No problem. So we've now come to a choose your own adventure juncture where we can do problem 6, or we cannot do problem 6. And problem 6 is a very deep dive into specified partnership income, so deep that my notes to myself when I printed this reformatted themselves into like size 2 font in order to fit on the page, which is extremely annoying. But so we can do that if people feel like they really want to understand specified partnership income, or we can leave it and move on to something else. So since we have the hand raising function, I will take a show of hands of people who want to do problem 6. And if you leave your hand down, I'm going to assume you just want to move on and talk about anything else. Well, snap, that is easily a majority. That is easily a majority. So in fact, that's basically a super majority. Now people are taking their hands down. But yeah, so we'll do it. I'm going to assume that we're just taking our hands down now because I've got the point. So yeah, let's do problem 6 then. Yeah, let's do it. So problem 6 is another specified partnership income problem. And in problem 6, our corporation ACO, which is the CCPC, has a 1/2 interest in 3 partnerships, which we're calling X, Y, and Z. So for our 2021 fiscal period, the partnerships earn or incur the following amounts. X partnership earns $200 of active business income. Y partnership earns $1,000 of active business income, and Z partnership realizes a $200 loss from an active business. So these are all calendar year partnerships, as an ACO is a calendar year taxpayer. For its 2021 taxation year, ACO deducts $300 of expenditures made by it for the purpose of earning income for business carried on as a member of Partnership Z. So let's assume for this purpose that ACO borrowed the money to acquire the interest in Partnership Z, which is where that $300 deduction is coming from. So the basic question is, what is the amount that ACO may add to its small business deduction base as a result of this? So I will now, unfortunately, try to read you an answer here, and God help me. Okay, so this is just not happening where I'm going to be able to pretend to follow this because I cannot see this at all. So we can only have a specified partnership loss to the extent that we have allocated that loss. So the only partnership relevant in computing specified partnership loss is Partnership Z. And we need to compute specified partnership loss, again, because one of our partnerships has generated a loss. And specified partnership loss, it has to be computed first because variable B of the specified partnership income definition requires us to factor in specified partnership loss from other partnerships. So basically, we know there's going to be a specified partnership loss from Partnership Z because it allocated a negative amount. And so we have to start with that and figure out how we're going to go from there. So specified partnership loss is a defined term in subsection 125.7. Again, it's an A plus B formula. Variable A is the loss allocated to the partner, which is $100 in this case, because it is ACO is a 1/2 partner of a partnership that lost $200. So its allocation is $100. Variable B is equal to the formula G minus H, where G is the amount of the deduction claimed in respect of the partnership for the year, which is the $300 interest deduction. And H is the income allocation to the partner from otherwise determined, which is 0. So variable B is $300. And so the result is that our variable A plus B, we have a specified partnership loss of $400 from partnership Z, which is the $100 loss otherwise determined, and then the $300 income allocation, $300 interest deduction in respect of the partnership interest. So now we have two other partnerships for which we can compute specified partnership income. We start with, given this, we can start with, actually it doesn't matter which partnership that we start with, because the process is going to be the same. We know in both cases that it's our A plus B formula. We know that variable A is the lesser of paragraph A and B, but given the numbers that we're talking about here, we know that paragraph A is going to be the lesser of the two amounts, because the total partnership income was less than $500,000. So it'll just be the actual allocation. So variable A for partnership X is $200, and variable A for partnership Y is $500. So relatively straightforward here. For both partnership X and partnership Y, the amount of variable B paragraph A, which is the loss from other sources, will be the specified partnership loss of $400, which was the one, as we determined for partnership Z. The amount of variable B paragraph B is nil for both partnerships, since there was no excess amount, because paragraph A of variable A was the lower of the two amounts. And so, what would actually theoretically happen for both partnerships, or at least maybe not for Y, but for partnership X, what would actually happen is that our variable B amount would compute to nil if we did that, but it won't. So variable B being the lesser of A and B is nil in the case of both partnerships. So as a result, there's a specified partnership income of $100 from partnership X and $500 from partnership Y is what we're allowed to have. So then the result that we have is that the partnership we're going to have our partner ACO is going to have specified partnership income of $600 that gets fed into paragraph 125(1)(a), and it's going to have a specified partnership loss of $400, which also gets fed into paragraph 125(1)(a). And so the result is that there's a net addition to the small business deduction base of $200. So that's our base iteration. So then we have a part 2 on this problem. And part 2 on the problem says, okay, well, what if instead of the $300 deduction being for partnership Z, it was for partnership X? And I actually don't think we need to go through that, because the result is exactly the same, right? Whether it's partnership, whether it's partnership X or partnership Z, the result is that we're just going to have $200 of specified partnership loss and we're going to have a reduction that we're going to have $500 of specified partnership income from partnership Y. We'll have $100 of specified partnership loss from each partnership. It's not actually going to make a difference in our net outcome. So we can not do that iteration, but we can focus on the last iteration, which is what happens if the $300 deduction was claimed in respect of partnership Y. So instead of having the interest deduction for the cost of acquiring partnership Z, the $300 interest deduction is in respect of the acquisition of partnership Y. So this does change the result. So now we do have a positive income allocation again from both of these partnerships, but it's a less positive income allocation, and we still have a negative income allocation from partnership Z. So the specified partnership income from partnership X is $100, and it's this for the exact same reason as in the base problem. So the specified partnership loss from partnership Z is $100. And the reason we're going to get to that number is, again, because our variable A loss allocated to the partner is $100. And we have no other deductions claimed in respect of our partnership interest. So the G minus H amount is going to be nil. And so our specified partnership loss just has to be $100 in that case. So partnership X, partnership Z, pretty easy. For partnership Y, what we're going to see here is that now there's a change to variable A, right? Because if we look at variable A, we know that variable A, paragraph A, is the amount otherwise allocated by the partnership, which is $500, minus the costs that are incurred in connection with the partnership, which were in this case $300. And so the result is that we have net variable A, paragraph A, of $200. And again, given the numbers here, we know that variable A, paragraph B, is going to be the greater of the amounts because it would be the proration of $500,000. So that's out. So we know it's paragraph A that will be our variable A amount. And so that's great. And so we have a $200,000 variable A amount. And then what's going to happen in paragraph B, or sorry, variable B rather, variable B, paragraph A, is going to be the specified partnership income loss of $100. And variable B, paragraph B, is going to be nil, since the amount actually allocated to the partner is greater than there's no excess amount. It's greater than the prorated based amount. So no paragraph B. So again, the lesser of these two amounts is nil. So we have no paragraph B amount. And so then we know that our specified partnership income from partnership Y must be the variable A, paragraph A amount of $200. And so then we go to subsection 125, 1, paragraph A, and we add in our $100 of specified partnership income for partnership X, our $200 of net specified partnership income for partnership Y, and we deduct our $100 specified partnership loss from partnership Z, and we end up at $200 of net addition to the small business deduction base under paragraph 125, 1A. So what the iterations of that problem are trying to show you is that it didn't really matter where we stuck that interest deduction at the end of the day, that no matter what, because of the way that the variables tie together, that you were always going to end up with $200 of net addition to the small business deduction base under paragraph 125, 1A, regardless of where the borrowing cost was incurred. So that one, that one obviously is not a super fun question. So that might be one where it would be worthwhile to just try to work through it on your own, and just make sure that you're getting to the same result, to make sure that you understand what's happening there. And so with that, I'm going to propose that we take a break for 10 minutes, and we'll come back at 3:10. So I'll just stop recording, and